One of the most common things early stage founders proudly say during a pitch is this: we actually have no competitors. No one in the world is doing what we are doing. They say it like it's a huge advantage, like they just discovered a secret gold mine. But to an experienced investor, that sentence is actually a massive red flag. Because when a startup has no competitors, it usually means one thing: there's no real market yet. And that leads to one of the biggest myths in startup culture: the myth of the first mover advantage. Startup culture loves the idea of being first. First to invent a product, first to create a category, first to change the world. The story sounds exciting. If you are first, you dominate the market. You become the next billion-dollar company. But when you actually look at business history, the reality is completely different. The first company usually doesn't win. The first company usually dies. The pioneer problem. The first company entering a new market is like a pioneer walking into the wilderness. They have to do everything from scratch. They have to convince people that the problem even exists. They have to teach customers how the product works. They have to spend millions educating the market. And most of the time, they run out of money before the market is ready. Then something interesting happens. A second company shows up, and because the market is now educated, they grow much faster. History is full of second winners. Think about social media. Most people think Facebook invented it, but Facebook wasn't first. Before Facebook, there was Friendster and MySpace. They spent years building the early market, and Facebook came later and executed better. Think about search engines. Most people think Google invented search, but before Google, there were companies like Alta Vista and Ask Jeeves. Google simply made search faster and better. Or smartphones. People often think Apple invented the smartphone, but smartphones already existed before the iPhone. Companies like BlackBerry and Palm were already in the market. Apple didn't invent the category. They just made the experience 10 times better. So the lesson is simple. Being first isn't an advantage. Sometimes it's actually a disadvantage. The real problem: market education. The biggest challenge for first movers is market education. If your product solves a problem people have never thought about before, you now have to convince them that the problem is real. And that's extremely expensive. Imagine trying to sell something like this: an AI agent that negotiates your utility bills automatically while you sleep. Sounds interesting. But the average person isn't actively worrying about their electricity bill every day. So now your job becomes very difficult. First, you have to convince them the problem matters. Then you have to explain your product. Then you have to convince them to trust your technology. That's a lot of friction. And most startups run out of time before customers care enough. The power of replace problems. Instead of solving new problems, successful startups usually solve replace problems. A replace problem is something customers are already spending money to solve. They already feel the pain. They already have a budget. They are already searching for solutions. You're not inventing new behavior. You're simply improving an existing. For example, imagine a company paying an accounting firm $2,000 per month to manage spreadsheets. Now your startup offers software that automates the entire process for $200 per month. You don't have to educate the market. The company already knows accounting matters. They're already paying to solve it. You're simply giving them a better option. The budget interception strategy. This idea leads to a powerful startup strategy called budget interception. Instead of asking companies to create a new budget for your product, you intercept money they're already spending somewhere else. Every company already has budgets for consultants, software tools, outsourced services, manual processes. Your job is to replace something they already pay for, not invent something completely new. Because convincing someone to create a new budget can take months or years. But replacing an existing cost is much easier. The better, faster, cheaper rule. When you replace an existing solution, your product must win in at least one of three ways: better, faster, cheaper. 1. Better. Sometimes you replace a product simply by making the experience dramatically better. A great example is Superhuman. Superhuman didn't invent email. Email has existed for decades, but Superhuman made the email experience faster, cleaner, and more enjoyable. And they charge $30 per month for something Gmail offers for free, because the experience feels premium. 2. Faster. Another way to win is speed. You eliminate waiting. For example, before tools like Canva existed, creating graphics meant hiring a designer. You had to post a job, get prices, wait days for revisions. Now tools like Canva let you create designs in minutes. They replaced a slow process with instant convenience. 3. Cheaper. The third way to win is price. Sometimes startups disrupt markets by offering a simpler and cheaper solution. For example, older enterprise software used to cost companies tens of thousands of dollars per year. Modern SaaS tools replaced many of those systems with affordable cloud products. Companies were happy to switch because they could get 80% of the value for a fraction of the price. The real barrier: switching costs. Even if your product is better, faster, or cheaper, there's still one major obstacle: switching costs. Companies hate switching tools because switching means migrating data, training employees, risking mistakes. Even if your product is amazing, the pain of switching can stop people from moving. So successful startups do something smart. They remove the friction. The migration strategy. Instead of asking customers to move everything themselves, great startups offer done-for-you migration. They say, if you switch to us, we'll move all your data for you. Imagine telling a company, our team will migrate your entire database this weekend. On Monday morning, everything is already set up. No headaches, no risk. This dramatically lowers the barrier to switching. The final lesson: startup culture celebrates being the visionary who invents something brand new. But most successful companies don't win because they were first. They win because they were better. They look at existing problems, existing budgets, existing frustrations, and they build a solution that is dramatically easier to use. So if you're building a startup today, remember this: you don't need to invent a new market. You don't need to change human behavior. You just need to find something people already hate doing and replace it with something 10 times better. Because in business, the first mouse might get the trap, but the second mouse gets the cheese.